Survive until 2025 is really the mantra for the multifamily industry, especially anyone that has purchased properties in the last 4 years. Is struggling because those properties, at least some of them, were purchased with bridge loans. This parasite organization that's developed these hundreds of thousands of brokers that are, in my opinion, receiving a shockingly, massively high payment for the service that they're offering, that will just simply vanish over the next 2 years. As far as I'm concerned, they were a massive inefficiency of the system that is now being removed. There's a lot of people in this call that believe that because there's so much distress in multifamily, because there's properties that are going to go back to the banks, that distress means that we could have 2 or 3 or 4 more bad years. And if you are thinking that, then you're just not good at math. There is no distress in the multifamily market and no chance of distress in the multifamily market. There is distress in the syndication market, and that distress is likely to continue until the second half of 2025. Now, today, I'm telling everyone that I can that it's...
Neal Bawa, welcome to the show.
Thank you. It's great to be on the show, and thanks for having me. I'll do the 2-minute version instead of the 5-minute version.
Let's do it. Yeah, let's do it.
I am a technologist, computer science background, data science is my major, and it is my obsession to bring big data and data science to real estate. We publish data that is used by 25,000 investors a year. We rank every city in the United States, all 323 cities every year. And we hold presentations talking about which of those cities are good for investing or bad for investing. We also do about half a dozen webinars a year where we talk about the challenges and the opportunities that we see in all kinds of commercial real estate, but with multifamily and built to rent sort of being the biggest focuses. But we talk about office, we talk about industrial, and a lot of other things. So I'm the kind of person that gets up at 5 a.m. and then reads for 90 minutes or watches YouTube for 90 minutes and then writes lots and lots of notes. And then I send that data out to my community. And so over time, very geeky, nerdy folks have sort of gathered in our community of 72,000 people. 1,000 of them have invested in our projects. So about $300 million of their money has been used for a portfolio that's about $700 million in value. And so we continue moving down that path, but we don't hesitate to go beyond real estate. We are not real estate people. We're people who follow data science, and we go where it leads us.
Cool. So you're kind of asset agnostic?
I completely am. For 2 years before 2024, I was telling people not to buy multifamily, and that got me a lot of enemies, actually. And a lot of people, luckily, I'm never on social media. So many people here would think that I'm on social media 24 hours a day. The answer is no, guys. That's a combination of virtual assistants and AI. I have no logins to my social media, and I've told my team in the past, change the logins, because even if I have them saved in LastPass, I do not want them to work. And so luckily, I've been protected from the backlash that I had over the last 2.5 years when I was telling people it was a bad time to buy multifamily, even though I love multifamily. Now, today, I'm telling everyone that I can that it's an incredible time to buy multifamily.
So you said you get up at 5 a.m. to do all this stuff. It must be nice to sleep until 5 a.m. every morning. How do you do that?
Yeah, I'm lazy. I'm lazy. What can I say?
Everybody.
Where's the right time?
You're not on social, but I'm an early riser. So I'm usually up at 3:30 or 4:30. So that's my ongoing joke is to make fun of 5 a.m.ers. But anyway, let's talk about you. Actually, right before we came on, as people were trickling in, you made a statement, and I figured let's just go with it, because it was an interesting statement. And you said that this was probably one of the most, I think you said, interesting times to be alive in history. That's quite a statement. You want to extrapolate? What is your quote exactly? And you want to extrapolate a little bit?
Well, this right now, 2024, is, in my mind, my opinion, by far the most interesting time to be alive in history. I can think of no other time in history that was this unique, both from the perspective of opportunities and dramatic risks. So we are coming to a time of incredible opportunity and incredible risk, both at the same time. So I'll first define the opportunity, and the opportunity is straightforward. There's a lot of people here with white hair. I've got white hair on the sides. There we go. And I can tell you this, that you've seen the internet, then you've seen the personal computer, then the internet, then the smartphone, three massive revolutions. The fourth revolution, which is now upon us, it's started on November 30th of 2022, is 1,000 times as powerful as these three. Artificial intelligence is the greatest revolution and the greatest threat to mankind ever. Just in the last 30 days, I have seen things happen that if you asked me 2.5 years ago, or maybe the day before November 30th, 2022, if you had told me that these things would happen in 2024, I would have tried to figure out who was supplying your meth, because it's clearly really good meth. So today, all of those things are happening, and they're happening in real time, and the change to our civilization over the next 5 years will be incredibly dramatic. So the next 5 years will be the greatest change in the history of mankind, the greatest rate of change. The opportunities created will be terrific. The overall net valuation of stock markets around the world will go up, down in crazy and wild swings, but eventually will go massively higher than it is today. So that's the opportunity. The risks are that the world is coming to the end of a 75-year era of peace since World War II. Globalization is ending, and as the world fractures into groups, that will have some very, very interesting and very meaningful changes for all of us.
Wow, we could do probably. I just found like 3 1-hour episodes on that little statement there. We could have a whole episode on AI, and I did have a couple of AI questions, so I was going to ask those later, Neal, but I might just ask them maybe a little bit out of order, because I was interested. I am interested in how AI specifically, obviously, it relates to real estate investing, and how folks who are on the call, what's the most practical application for them in the next couple of years. So I want to get to that. But actually, I'm going to go back to my original kind of my thoughts or my agenda, which was kind of to get back a little bit more high level and start with sort of the big picture, maybe even, economics as a whole, or obviously the real estate market as a whole. I don't think you invented the term, Neal, but you are well known for saying, hey, is it survive till 25 or thrive until 25? So give me your option.
I've shamelessly stolen that
Yeah.
from other people, but survive until 2025 is really the mantra for the multifamily industry, especially anyone that has purchased properties in the last 4 years, right? And is struggling because those properties, at least some of them, were purchased with bridge loans. And even if they were not purchased with bridge loans, if you have one of those fixed loans coming up for renewal in the next 12 to 15 months, right? That's your mantra, survive until 2025.
And do you think then, once we get past this dominoes or this phase of these loans that are coming due, whether they're bridge loans or what have you, then literally starting 2026, sometime in 2026, so you think we're starting the next phase, the next market phase? Is that kind of how the way you see it?
Absolutely. I absolutely see it as a next market phase. And I see it as as a pretty booming phase that maybe go on for a number of years, subject to whether the US and China get into a shooting war. So that's the kind of the X factor. A lot of people ask me this question, Mauricio, what is the next, black swan? Well, apart from AI, which we could, as you said, spend hours on, the true black swan event is a shooting war between the US and China, which would take inflation not into the double digits, but into the triple digits. So some things would instantly triple or quadruple in cost. Other than that black swan event, I think 2026 is the time when a new cycle starts, with 2025 being generally a year where, as the year goes on, investors will get more and more bullish about all sorts of real estate assets, not just multifamily. And I'll explain why. There's a lot of people in this call that believe that because there's so much distress in multifamily, because there's properties that are going to go back to the banks, that distress means that we could have 2 or 3 or 4 more bad years. And if you are thinking that, then you're just not good at math. The total multifamily industry, I'll use multifamily as an example, has a value of $4 trillion before interest rates started going up. Today, that value has decreased to $3 trillion. According to the new STRD matrix report, which came out this week, multifamily is down 25%. I'm quoting directly from the report. So that 4 trillion became 3 trillion. Now, out of that $3 trillion, the total number of properties that are at risk are worth $90 billion by my number, $67 billion by Bloomberg's number. So I'll go with the higher number of the two just to be conservative. So 3% of all multifamily in the United States is at risk. Recently, a phenomenal article came out that actually sliced and diced the entire multifamily industry so that you could understand what part of it was at risk, right? Because obviously there's properties that were purchased before 2018. I don't care if they have a bridge loan. They have so much equity that all that's happened is some of their profits have decreased. Properties that have been purchased in the last 20 or 30 years that have fixed loans or that have hard loans, they don't care about what's happening in the marketplace. And that is the vast majority of markets of properties. In fact, only 15% of the entire multifamily industry has bridge loans. And many of those bridge loans don't trigger in 2024 or even in 2025. Some of them actually trigger in 2026. So you would really have to understand the size of the problem. So the size of the problem is both very big and very small. As a percentage of a $3 trillion industry, when you have a $90 billion problem, what's the worst that can happen? $90 billion are lost. Will that create contagion? No. Will that create pain for thousands of investors? Yes. But even if all of those $90 billion worth of properties were sold for $1 each, which clearly is not the case, they're being sold at a 25% discount. Even if it was, $90 billion is not enough to cause contagion or long-term distress in a $3 trillion market because that's 3%. Actually, what will happen is this $90 billion worth of properties, they'll be sold for $60 billion. So you have $30 billion in losses. That's 1% of the size of the multifamily industry. So I'll say these following statements. I like to be very crisp with my words. There is no distress in the multifamily market and no chance of distress in the multifamily market. There is distress in the syndication market, the syndication portion of the multifamily market, and that distress is likely to continue until the second half of 2025.
This is what I love about Neal is that most other people are grabbing headlines from other people or whatever. And Neal actually has done the deep dive, has looked at the numbers and actually backs up his statements with actual data. Cause I actually was, Neal, I'm here to try and disagree with you. I'm supposed to be playing devil's advocate. So I was going to ask you about, how many of these are currently not viewed as being at risk, but, just because, maybe their loan isn't adjusting for another 2 or 3 years. But if interest rates remain high over the next 2 or 3 years, eventually those people that could become at risk. But then to your point, that means they bought property back in 2018, 2019, 2020. There's plenty of equity. Yeah, they may not make as much money on the exit, or they may even, so that makes a ton of sense. So what does that mean for you and your companies? What are you trying to do right now between now? I guess we've got another 12 to 18 months between now and, beginning of 2025 or middle of 2025, or maybe 12 months. What are you guys doing then? Are you just literally hunkering down and getting cash reserves up? I mean, what's the strategy here?
So the answer is, I'm buying anything that I can buy today with a assumption. Assumptions are very hard to find. So I've stopped. I have an acquisition team. As you can imagine, Mauricio, when we finish an acquisition, they get a bonus, correct? We no longer provide bonuses if it's not an assumption. So we basically changed our internal structure, which is, hey, I'll buy a property if I like it that doesn't have an assumption, but you can't get bonuses. Before I changed my structure, assumption properties were almost impossible for my team to find. Now they seem to be much easier. So aligning incentives with investor, benefits is a fantastic thing. And I'll just say this so people completely understand what I'm about to say. Today, anyone in the industry, anyone in this room can receive a 25% discount on multifamily from Peak, which is not a 25% discount. It's just from Peak. It's about a 12% discount, 12% real discount, 25% from Peak, right? Because that Peak was already a nonsensical Peak. So you're getting that 12% discount, which for an asset class like multifamily is unique. It's only happened once before in the last 100 years. It happened for a short amount of time in 2010, short amount of time. And when you're assuming a loan, you're not taking on the additional risk that has caused that discount, right? So something has caused that discount, and that is interest rates. But when you assume a loan, you don't take on that risk. So you're receiving a discount without taking the risk that should cause that discount. And that is an extraordinarily unique position. It has happened before, but generally it happens when unemployment rates are at 8%, not 4%. It generally happens when the US economy is in a recession, or it generally happens when there are extraordinarily illiquidity issues, like we saw in 2008. There's no illiquidity in our market. Banks will give you 100 loans today if you want them. They just simply will do them at a lower price. And since you're buying, not selling, you're the beneficiary of that lower price. So you love the banks for wanting to give you smaller loans because that's what's forcing the price down, right? The price of multifamily has always been very tied to cap rates. Cap rates go up, prices go down. Very simple, very straightforward. If you look at the last 18 months, it's a very smooth curve. What does that mean, right? That means simply this: when cap rates go down, prices will go back up. It is, if you're data driven, you have to be bold enough to understand that there are two sides of this coin. The same thing that took prices down smoothly over the last 18 months will take prices up smoothly when things reverse. The Fed's already said that we're going to cut rates 3 times in this year. They've already said we're going to cut them 4 times next year. So far, the Fed's done exactly what they've said. Wall Street's been wrong. The Fed's been right. So if they're going to cut the rates 7 times over this year and next year, and probably will cut more, but let's just say 7, that actually has a upward effect on prices, not a downward effect. Now you might say, well, yeah, but there's 3,000 properties that are being sold at distress. Let me define distress, okay? Because I think most people actually, Mauricio, don't even understand the word distress. Distress was 2008. Why? Because when a property that was sold for $300,000 in 2007 was then sold to Neal Bawa, who was buying a property every month for $90,000, right? Well, the bank took a huge haircut on that because the property was sold at 33, 34% of its selling price. That's distress. Almost all of those properties, those 3,000 properties that are at risk and will be sold most likely in the next 12 months, the banks are okay. So there isn't a distress to the financial system. The banks will recover either all of their money or the overwhelming majority of their money because the value is dropped by 25% and the equity usually is 30. So there are only certain instances in which banks are taking haircut. Therefore, the word distress doesn't apply. So I will simply say, those 3,000 properties will cause insane amounts of pain and distress to the syndicators and to the investors, but in all likelihood will cause very little pain to the banks.
So how do you find then, because you're obviously buying, I presume the argument is, look, a year and a half, I'm going to be holding on to these things for more than a year and a half, so I can sustain whatever downward pressure I have over the next year. I presume you're not just buying anything. I mean, I know you're not just buying anything, that comes up. So you're obviously looking at particular markets. And so I'm interested to know what your approach is to finding those markets. And maybe more importantly, your unique angle is, how do you use data to actually uncover these markets that maybe other people aren't even looking at because they're not looking at the data?
I like to stay ahead of the marketplace. So for example, today, there is no benefit to me to talk about places like Jacksonville because there are a dozen people who teach multifamily syndication and charge $50,000. By the way, I do not teach syndication. I don't charge anybody for anything. All of our data is free. It's on our website, and you don't even have to, there's no subscription. We don't charge $99 a year for our data. It's always free. It's always meant to be free. We believe in a Wikipedia-based world of data, right? So it's just there for people to use it. So to me, there's no benefit to talk about the same markets that everyone is talking about. I like to stay 2 to 3 years ahead of people on markets that I'm looking at today. So today, to talk about Texas markets, Florida markets, North Carolina, South Carolina makes no sense whatsoever because everybody knows. Where's the opportunity in that? I'm interested in what is the next set of those markets. So for example, anybody who knows me knows that in 2016 and 2017, my beginning of the year presentation is called Real Estate Trends. I talked about a city called Provo, Utah. And I said, this is the best city in America to invest in. You can check out my 2016 and 2017 presentations on YouTube. Now you notice that in 2020 and 2021, back-to-back, Provo won City of the Year from Milken Institute, which is the most important single ranking in a year for cities, right? So Milken comes out with this ranking every year. In 2019, we started talking about Idaho Falls. And today, Idaho Falls has won in 2021, 2022, and again last week in 2024. 3 times in 4 years, the only city out of 1,000 cities to win 3 times in 4 years, right? But most people here don't even know where the heck Idaho Falls is, except it's in Idaho, right? They don't understand what's happening there. So when I talk about these sorts of places, I'm always looking at the next city. And sometimes they're big and sometimes they're small. Today, I'm not talking about any city in in Texas or Florida, because everyone knows, right? But I'm talking about Kansas City, Indianapolis on the bigger side, 1.7 million people roughly. And I'm talking about smaller places like Northwest Arkansas, the city of Bentonville, the city of Rogers. My data, because we rank cities every month, internally we rank them every month, externally we share it once a year. It shows whatever that next set is. And it takes about 24 months for the market to catch up. And that's what we do. This, by the way, what we do is not magical. I do not use AI. I do not use even big data. We simply take about 100 different metrics. We weight them. Some have higher weightage, some have lower weightage, and we create a weighted score. And then we discuss it every month. We ignore the cities that show up once or twice, and we look at the cities that are there constantly, and we go invest there.
And I was going to ask you, so I assume what are, give me kind of the couple of the, maybe 2 or 3, is it sort of jobs creation? Is it where people are moving to? Are those kind of the metrics that you're measuring, or does it get even more nuanced with your data? I mean, 100 is obviously a lot, but what are the top 3 like really big?
Yeah,
big
I'll give you the ones that have the higher weightage.
Yeah.
Right. So, I mean, it's population growth, job growth, home price growth, income growth, and crime reduction. Those are the 5 big ones. And then, and a lot of people are like, what about schools? The answer is crime reduction is inversely proportional to schools. As crime is inversely proportional to schools. We find that if we look at cities that crime is reducing, the schools are always going up. It 100% of the time. So there's factors that it sort of takes care of it. And then we look at supply, right? So what we've done is, in the last 2 years, what we've learned is we should triple the weightage that we used to assign to supply, incoming supply. So for us, if you look at 3 years ago to now, the biggest single change is supply. The second biggest change is that we added a new factor in, and that new factor is reindustrialization. We now give higher weightages to cities that have large infrastructure as manufacturing returns to the United States. We haven't fought a shooting war with China yet, but it's inevitable. So when that happens, cities that have industrial and manufacturing capabilities will all of a sudden become magnets. So we give it significant ratings. So like, for example, Indy, Kansas City, Oklahoma are not sexy cities, but they have amazing infrastructures that are going to be used over the next 5 years, regardless of whether we fight a war with China or not. It's clear now that deglobalization is occurring. So most of that deglobalization will go to Mexico, not to the US, but some of it is still going to the US.
I'm surprised you're not using, and thanks. I see a couple questions here that I'm going to get to in a second. So if you got your questions, please drop them in. I'm surprised you don't use some form of AI in doing this, because I mean, I know enough about AI to know that I know absolutely nothing. And I could see how something like AI, once you figured out what your parameters are and how the weighted, that you would just be feeding this data into some AI technology that's basically going to be spitting out, it can obviously analyze, as smart as you are, Neal, AI can analyze and sort data pretty darn well, right?
Yeah, I mean, I'm not suggesting that I'm not using tools that don't have intelligence. We do, right? So the big data tools already, for the last 20 years, have had the ability to create and show us insights. So I'm not suggesting that our tools are dumb. They're quite smart. Artificial intelligence, though, is people use the word AI in the wrong way. So I will once again use it very crisply, right? True AI or generative AI is the process of taking extremely large data sets, let's call it 500,000 PDF documents, putting it into a software and asking that software to learn, right, through a process called inference. I'm not aware of anyone in real estate that has actually done that. The only company that I think may actually have that much data and may actually achieve something unique is called CoStar. So, because keep in mind that first you have to put in an extremely large amount of data. Inference doesn't work when you put in 1,000 documents. It works when you put in 1 million documents. Also, inference only works with certain processors. A company called NVIDIA makes them. So you're talking about something that actually costs millions of dollars to do. So when people say the word AI and you see all these real estate startups saying we do AI, they're using a watered down version of the AI that we get from ChatGPT, because that level of intelligence requires millions of dollars. And I don't think anyone in real estate has those millions except for CoStar.
Yeah. And speaking of CoStar, this is gonna be a beautiful segue to another topic I want to touch. As we're going all over the place, but CoStar is been labeled, at least what I've been reading over the weekend, as one of maybe the biggest benefactors of this new NAR settlement. So as you guys know, the National Association of Realtors got into this huge settlement last Friday, basically agreed to get rid of their what some people call sort of antitrust practice of having this 6% commission that's, you know, split between buyer and seller, but the seller is actually paying for that commission. I wanted to ask Neal what his thoughts are, whether he thought this was as revolutionary as some people think it is, and that it will in fact lower and change, really, at the end of the day, change the model, change the landscape of how you buy and sell single families. But I did know that CoStar was one of the companies that was popping up as one of the biggest benefactors of this, because they have alternative ways of marketing and selling stuff, which may have a competitive advantage. But Neal, what are your thoughts on this Realtor Association settlement, where they're apparently getting rid of this model? It's a completely new model from what I'm reading. What are your thoughts on that?
It's a huge change. So first, for anyone that doesn't know, the National Association of Realtors has basically agreed to disband the 3+3 commission system, which, you basically, if you put a property up on MLS, you had to offer 3% commission to the broker that was bringing in the client. You no longer have to do that from July next year, or I think it's March next year, something like that. So what this means is this parasite organization that's developed these hundreds of thousands of brokers that are, in my opinion, receiving a shockingly, massively high payment for the service that they're offering, that will just simply vanish over the next 2 years. It's going to go the way of the dodo. So firstly, I expect that half of all single family real estate agents in the United States will be out of business in the next 24 months. The second impact is to the positive impact is to the homeowners. Homeowners right now essentially are paying 6% of the home price to sell their home. I expect that number is going to go to 2 or 3% within the next 2 years. So they're basically, their cost of selling is reduced, which means that more homes are going to be sold. They're more liquid assets now. That 6% has gone to a more reasonable, call it 2 to 3%. And then all of the e-buyers and e-sellers, people basically that built websites that allow you to transact for 1%, 1.5%, they're all dancing with joy, because they are now going to become the de facto new standard, right? What was holding them back, what was holding technology back, and holding homes from being commodities that are sold on apps, was this commission, this outrageous old commission system that basically forced you to pay all this money that you never really needed to pay because of these apps. So I think anyone that has technology, and CoStar has plenty, is the beneficiary. Homeowners are beneficiaries. Cost of selling homes goes down. And a parasitical industry finally, 20 years after it should have, when the airline, travel agent industry was disbanded, this is when they should have happened 20 years ago. But now it's finally going to happen. And I think it's good for everyone. As far as I'm concerned, they were a massive inefficiency of the system that is now being removed.
One of the concerns that I saw, which I was trying to think through this argument over the weekend, is that because of this shift in the model, you are likely to lose a lot of real estate agents. To some estimations, maybe half of the real estate agents may be gone. And people argue, well, that's good. The good ones will stay, the crappy ones will leave. But at the end of the day, I was thinking through this, and I'd like your thoughts on this, Neal. Anytime you have a reduction in supply of something like services, then that generally means one of two things. Either the price of that service is going to go up, or the quality of that service is going to go down. How do you think the impact of people leaving the real estate agent services is going to impact pricing or quality of agencies?
It won't go down simply because of artificial intelligence. So what's happened over the last 20 years is dozens and dozens of high quality services have been built, but they haven't gotten their due. They haven't gotten their true value because of this old archaic system, right? Think of what is happening in the real estate industry. Imagine how furious you would be if, the city of New York said, oh, only taxis can drive here, Uber can't drive here. Uber, no Lyft, no Uber. That's really what they were doing. They were using the law in the way that it was never designed to prevent technology from moving forward. So I think what will happen is service levels will not fall because the technological, sites already exist. They will get better. They will step into that gap. So I don't expect that we'll see any level of reduction of service.
Cool. DJ was asking that he has sometimes doubts CoStar's data. I want to get your thoughts on this. Just thoughts that maybe brokers may have better data, insurance, whatever, due to these recent deals that may be retraded. What's your level of confidence with the CoStar data? I know most of us rely on it. Is that something that you like their data, rely on it? Is that high quality data that you rely on?
Once again, my answer is nuanced. I do not believe in CoStar data when it comes to cap rates. Because firstly, major states like Texas are non-disclosure, so they have to guess, and I don't like anybody's guess. CoStar's guess is as bad as my guessing. So I think their cap rate data is pretty awful, but their rent data is incredibly accurate. Why? Because they own apartments.com, which is the #1 site for rent. So every single morning when people like me go and change our rents there, that information is sucked overnight into the CoStar database, which is updated the next morning. So when it comes to rents, they are phenomenal. When it comes to cap rates, they suck.
Phenomenal. You made a comment about the banks earlier not having issues, and somebody had a comment in here, so I just lost it here. Oh, DJ, are you saying the banks won't face issues because of the LTVs and the equity and the value of the property? Is that why you don't think they'll be affected, or just it's just such a small number?
Yeah, it's a small number, right? So perfect example, Dallas, property that was purchased for $40 million was recently sold for 30. Well, its loan was 29 million. So the bank lost $1 million. The investors lost $10 million, right? Or a little more because they also had cash calls. So 11 or $12 million of investor money was lost, but $1 million was lost for the bank. And keep in mind, the Federal Reserve has forced all mid-sized US banks to increase the number of buffer that they're holding for these anticipated losses. The Fed's not sitting still. The Fed is saying, if you have this much exposure in commercial real estate, you need to put this much money aside for when these loans fail, because I don't want to run on your bank. So the Fed is doing the right thing. It's already taking the necessary actions that will happen is, that the Fed thinks is going to happen for mid-sized banks. Large-sized banks don't care about these numbers. These are very, very small numbers.
Yeah, and any thoughts on the the recent I don't want to call it the bailout facility, but the long-term lending facility that was just expired in March that a lot of banks were still using? Do you have any thoughts as to whether they were using it because they needed it, or they were mostly using it as an arbitrage because they were getting cheap money based on the thing? So for those of you who don't know, the Fed had a program in there that basically was lending banks who needed cash on a very favorable basis, and that program just literally ended, I think, last week, and there's been a lot of thoughts back and forth whether that's going to be causing some issues with the banks or whether that's really a non-story. Any thoughts on that?
Totally non-story, because the Fed has the right to restart that whenever they see any evidence of contagion. I mean, the Fed needs less than 24 hours to restart that program, and the Fed has already stated publicly that we'll restart it whenever we need to. I think just giving free money away for no reason is just bad because it makes the banks lazy. But if anything happens, the Fed can restart that like this.
You don't think that'll cause some turmoil though? And if they see that they tried to take away the stimulus and the banks lasted 3 months and now they're in crisis again. So, I mean, is that like a little bit of a black swan in your opinion, or not a big deal?
Not really. I mean, the Fed, there's this concept called quantitative easing. If you look carefully, the banks have been the Fed has been doing quantitative tightening for now 18 months. They have removed hundreds of billions of dollars from the system, hundreds of billions of dollars. I don't see any evidence of contagion. So I think that simply making the assumption that the banks won't function unless they have liquidity is not true. I think that the banking system is in a much more stable place than it was in 2008 when all kinds of bad things happened. Now the buffers in the system are functioning. And once again, the Fed tends to move very quickly to reopen the discount window if it's needed. I mean, again, the discount window can be opened literally in a day.
Yeah, 100%. So Nick has an interesting, I'm going to read Nick's statement because I love your thoughts on the statement, but also I want to whatever the term I was going to use, whatever the word is, but I also want to go into kind of your thoughts on how everyday real estate investors can leverage AI in finding markets or whatever. But Nick says, you know, real estate's in niches. AI cannot accurately look at 100-year-old houses that are 3 blocks east of a $100,000 house and 3 blocks west of a $3 million house, et cetera. You can't gather that amount of data in a computer. Do you agree with that statement? And again, how can the everyday syndicator who's looking out there looking for a good deal leverage AI technology to just make themselves more efficient or have a competitive advantage?
I don't think you do it by yourself. I completely agree with you. I mean, boots on the ground is boots on the ground. And I don't think in the age of AI, boots on the ground is very different. I think what AI helps with is figuring out whether this is the right time to buy multifamily. Where should you buy multifamily? What state should you buy in, right? It helps you with a lot of those kinds of things. But when it comes down to the actual property, the only thing that works is boots on the ground. Unless we get robotics with AI, which by the way is what happened last week that completely blew my mind. Until we get robots, the boots on the ground is just as critical. So the good news is, if the boots on the ground was not critical, you would be out of a business. I would be out of a business. Mauricio would have to open a different practice. So there's actually a benefit that not everything can be automated by AI, at least not yet.
Paula reference, I think I know you're on the speak at circuit more than I am. I think you had been talking about, and this is from Paula. You have a map showing, you know, where rents are decreasing. I don't have it, unfortunately, to show it up there, but where does that fit into your model? Obviously, that's probably an important metric for you to look at if rents are going up or down a particular market. Is that coming from this analysis you do, this 100 metrics analysis that we just talked about earlier?
Not at all, because I find that the only reason rents are going down in some of these markets is incoming supply. So unless I see multi-year supply coming into a market, let's say a market has huge supply in 24, 25, 26, 27, unless that happens, it doesn't matter. Rents are adjusting. All of the markets that have negative rent growth, aren't they the same exact markets that had ultra high rent growth about 18 months ago? All that's happening is these markets are adjusting to incoming inventory. So if their fundamentals are strong, which are all the other things that I track, then by the time the market gets out of this slump, we'll be in a good place. One of the things that CoStar does do a pretty good job of is tracking or predicting future rent growth. So it does it predicts it, and it's starting to use AI in its predictions. But basically, it's based on supply and all the other demographics thing that I just mentioned. So CoStar's got all of my demographics, plus they have more supply data than I could possibly get. So their forward-looking predictions are good. If CoStar's saying that the forward-looking predictions in these markets are strong, go ahead and buy. If CoStar's saying the next 2 years are weak, maybe you should not buy it, regardless of how good the market is.
I had a great question from Ava about accredited investor stuff. Ava, I've only got Neal for a couple more minutes, so I'll answer that once Neal gets off about, you know, how the SEC is dealing with accredited, changing the definition of accredited investor, unless Neal has a comment on it. I know Paula was asking what the hell is going on in Idaho besides potatoes.
Idaho, so Google fastest growing state in the United States and click on the Idaho link. So I think that Google does a very good job of this, but in essence, potatoes is, what they're known for, but that doesn't mean that that's what they do today. That's what they did 100 years ago when they became the potato state. 100 years is a long time.
It's like Medellin, right? Everybody was thinking, you think of Medellin. I did this maybe 5 or 10 years ago. Somebody wanted to raise capital, do a syndication in Medellin. And I'm like, isn't that the cocaine capital of the world? Isn't that where Pablo Escobar used to live in Medellin, Colombia? And he's like, yeah, that was not 100 years ago, but that was a long time ago. And Medellin has now turned into this apparently
It's a gorgeous city,
gorgeous place.
and
Yeah.
Absolutely terrific place to visit.
So Neal, look, I really appreciate, I know you're super busy, especially in this time. Really appreciate you taking the time to come out here. What's the best way? I know you got a couple of, you do a lot of webinars, you do a lot of a lot of education. You've got some sort of like a little university going here, or a big university. Tell the folks how the best they can get more, not only information about yourself, but also these webinars, these amazing webinars that you do.
So if you like watching long form webinars, go to multifamilyu.com. That's multifamily followed by the u.com. You'll see dozens of them archived. They're all available for free. And then of course you'd be registered to get new ones. If you like short form, go to YouTube and type in Multifamily University, and you'll notice that there are a large number, tens of thousands, well, hundreds of thousands of views every month on our content. And you can just select whatever videos you like. We have short ones and we have large ones.
Do you want to send anybody else anywhere to get a hold of you, or is that the best place to kind of find? Well,
that's really the best place.
Yeah.
I mean, hey, I don't believe that I should send you to a website where you can invest with me. Join our community. 2-3 times a year, you will see our offers. That looks interesting. Jump in. Don't be in a hurry. I don't believe that the opportunities that we have in multifamily are going to disappear over the next 12 months. I do think they're going to disappear over the next 24 months. So you have time. Take your time. Don't be in a hurry, right? I think the only thing I would be in a hurry today is to buy every available stock of a company called Figure AI. Figure Space AI. The company is not public. The stock is only available through third-party websites. So this morning, I registered at 4 of them and tried to buy Figure AI stock.
This is not a stock recommendation. Please invest.
It is not a stock recommendation. I am. Thank you, Mauricio. Thank you. Thank you. Thank you.
Thank you, Neal. I appreciate it. Everybody give Neal a thank you. I'm going to stick around for a couple more minutes to answer some of these other legal questions. But Neal, thanks so much for your time, man. I really, really appreciate you being gracious with it.
Thanks for having me, buddy. Bye-bye.
Good seeing you. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.